for the day and Gaurav. Friends, I am sure all of you have been very eager to attend this session on account of the far-reaching changes that have been made in the GST law in the recent meeting. We were in fact waiting for Divyesh. We were expecting him that he would get late. But as we all know, the GST practitioners are supposed to be supermans, and Divyesh has made it on time for the meeting. So thank you, Divyesh, for being the Superman for the day. Friends, the far-reaching impact of the GST amendments that has been proposed by, implemented by the council, and the eagerness of the participants to understand this law. We have more than 550 participants who have registered for today's webinar. I welcome each of them to this session. Today is also a special occasion, being the birthday of our beloved Prime Minister, Shri Narendra Modi ji. And on behalf of Bombay Chartered Accountants Society, we all wish him a very healthy and a long life for a prosperous India. Since there are a lot of non-members as well who are attending today, I will take few moments to introduce the Bombay Chartered Accountants Society, which was established in 1949 and has more than 11,000 members across 350 towns and cities of India. And I would say that this is truly a Bharat Chartered Accountant Society, being represented by chartered accountants from all nooks and corners of the India. Friends, BCS organizes various programs through its committees, which are technical and non-technical committees, consisting of the technical committee being consisting of the accounting auditing, indirect tax committee, direct tax committee, international tax committee. Similarly, the non-technical committees being HRD committee and technology committee. And the flagship product of BCAS, which is the BCAS journal, which encompasses various useful knowledge base and material for practitioners as well as members in industry. BCAS is mindful of the requirements of the members, not only in terms of the technical requirement, but also to ensure an overall well-being of the members, where the non-technical committee plays a vital role like an HRD committee. Friends, we are also aware that now we have members who are from 350 towns and cities of India. Not only do we organize webinar, but we also have a platform called BCAS Academy, which is available to the members and consists of various useful, not only the study material, but even the recorded videos, which are available for the members at their disposal. And I request all the members to take benefit of the BCS Academy platform so that they can enrich their knowledge, network with like-minded people, and share their achievements in terms of various issues also which they are facing and the professional achievements. Friends, I am aware that considering the amendments, Divyesh would need sufficient time, and without taking much of the time, I would now request the conveners to take the proceeding forward, and I welcome all the participants to this learning platform of BCS. Over to you, Gaurav.
Thank you, Kinjal bhai. Without wasting much time, I'll like to introduce our today's speaker for the topic on GST 2.0, CA Divyesh Lapsiwala. So before I proceed with his detailed introduction, I would also like to mention that he is a core group member and also member of the Bombay Chartered Accountant Society. Divyesh is a partner with indirect tax practice and leads the insurance sector for tax in EY. And he also leads Mumbai's technology, media, and telecommunication, that is a TMT team. He has more than 24 years of experience in advising clients on various indirect tax litigation. He supports some of the key EY tax technology solutions and works with the clients to curate their technology roadmaps. He is also the core group member of EY AI initiatives in tax as well as the tax areas. Divesh has experience across sectors including financial services, media and entertainment, logistics, IT, ITES, retail, infrastructure, manufacturing, and telecom. He is handling large complex projects relating to restructuring, transformation, technology implementation, and optimization. Divyesh has led several advocacy projects to work with the industry and regulators to make the tax policy more implementable. He has experience in handling tax controversy matters, including investigations and court disputes. He is a regular speaker at the indirect tax conferences and has made several editorial contributions on this subject. So we welcome you, Divyesh, for today's lecture meeting, and over to you to carry forward for today's session.
Thank you to BCAS, and thank you everyone for your time to join this session. And I'm very pleased to be a part of this. Thank you, Govind Goyalji, for giving me this opportunity. And always a lot of love and passion for the BCAS. So I grabbed it with both hands. Hopefully, I'll be able to do justice because the changes are sweeping multiple sectors. I have supported my talk today with a slide deck, which I will put up now. The deck will hopefully help us, navigate this change in a slightly structured manner, and that's my objective. I've tried to cover several sectoral impacts as well. So there are some sector slides which hopefully should give a sector cut to what we are doing. I just want to confirm with Gaurav if the slide is properly visible.
Yes, it's visible.
Okay,
You can put.
thank you. So if we go to the headline, and I think we all know the big aspects broadly, but just to contextualize, we've tried to bucket this into three themes, and these were the themes. Uh, These were the themes that the FM had laid out in her conversation when she did the press conference just after the GST Council meeting. First, of course, is rate rationalization. Second is very, very important structural reforms. Third is trade facilitation. We will start with structural reforms and trade facilitation, and then we'll go to rate rationalization because uh, 2 and 3 are quite significant, and they are also very directional. They're giving you a hint into what is coming in the future. So it's important to appreciate what the government is thinking. On the rate rationalization, there are, of course, for goods, there is complete clarity on what is the change in rate and whether input tax credit is available or not. From a sector lens, there are some important points that come up. So rate rationalization, we will discuss more from a sector lens standpoint. On services, the complication is slightly higher because we only have a few sentences or words that have been written for services, and there is a lot of the unknown in service sector, which hopefully by notifications in a day or two will be clear. We were hoping that notifications would have come by today and we would have discussed the notifications. So we have a customs amendment notification that came out just half an hour back. It's some 50-page document, which is basically the header of the notification is that to incorporate the rate changes of GST, the notification has been issued. So I'm hoping that by end of day today, we will get a bundle of notifications for all of us to analyze, confirm, and so on and so forth. But but we will go to that section in a bit. Before we go to rate rationalization reforms, I have covered a small snippet on transition of these rates. And there are multiple technical problems and business problems around transition. So we'll touch upon some of those. And in the end, we will try and talk about what industry is doing, or how is industry reacting, or what industry needs to do to deal with this. So what are the really high impact points? What is happening on the advocacy front? There is a lot of discussion that is happening with the government. So to the extent I'm aware, I'm hoping to share during our conversation. So coming back, three broad pillars: rate, structure, and trade facilitation. We go and deep dive into each one of them as we go along in the discussions, right? Uh, I will make a broader point that very few countries who have our kind of tiered structure have been able to fix all the goods in a two-tiered structure, right? So it's not easy to do what India has done. India has never been able to do it even in the VAT or sales tax days. We've always had multi-tier because of the feeling that there is a standard rate, there is a merit rate, there is a demerit rate, but in between the merit rate and the standard rate, there is a need for a rate, or below the merit rate, there is a need for a rate. So we've always had plethora of rates. GST was able to bring it to 4 rates. To bring it to 2 rates has been a very, very tough job for the government, and not just from a revenue standpoint, but also from the standpoint that you are moving away from the principles that have been followed for so many years. It is hard. It will bring in revenue loss, or it will bring in impact on certain sectors where the rates are moving up. So it is a significant milestone. Uh, Again, keeping the rate at 18% is a significant achievement. I can suggest that if you look at how we started GST, and we started with a revenue neutral rate of about 14.8%. So when the Finance Commission had done a report on transition to GST from all the taxes that we had in the past, the initial revenue neutral rate was 14.8%. There is a very interesting Axis Bank study that was released after this rate rationalization that was announced. That if you see the last year's published numbers of the average effective tax rate on products in India, so this is just average effective rate. So it obviously caters to exemption as well as to 50% category. All categories taken together had come down from 14.8% to 11.2%. Okay. It is expected that this rate rationalization will bring it down maybe marginally below 10%. Okay. Now, this, if you think from in a 7-year, 8-year journey, from an effective rate of 14 to 15%, to bring it down from 10 to 11% is in an economy which is growing only 6-7% CAGR. We are not growing 14% CAGR. Is very, very meaningful. Okay, and is a call out to compete in Southeast Asia market, not necessarily in the European market. So if you look at the European market rate structure, the European VAT, UK VAT is 21%. So European VAT ranges from about 17-18% to 22%, and they cover all goods and services. So we were earlier seeking comfort that our rates are not very high because we were looking at European VAT, Canadian VAT. But now we're looking at our Asia Pac peers, we're looking at Australia, we're looking at Singapore, Southeast Asia, and we are trying to compete with them in indirect taxes. We are also trying to reduce the dependence on indirect tax in the economy, and therefore tax the rich more, tax the poor less. Very, very bold move, and it's very, very commendable. I think the size of this change is quite material. It is not limited to this commodity is going to become cheaper or this commodity is becoming more expensive. It is a directional change which is going to be very hard to reverse. I will find it very difficult for any government of the future to now say that I go back and introduce a 12% rate. And so, at least my personal assessment is that this is a long-term change that we are seeing. And when you see such a long-term change, you know that this is going to give a lot more certainty to business, because all the products which are mass consumption are at 5 or 0, and all the products which are B2B or middle class plus consumption are at 18 roughly. And that's it. Yes, there is some premium class which may be taxed at 40%, but otherwise a disproportionate majority, almost 70% plus of the revenue is going to come now from 18% category. Again, very, very meaningful change. So, so hard to move away from this. We are moving to effectively a single rate of tax. Okay. And very, very commendable as a change. So I think we should look at it from that perspective. Uh, of course, when I look at my own business, I will have my own challenges and I will go and present my own asks. But in the larger picture, the government can do as much as they can do, and there are certain things that may happen in the long run. So that's on the rate. On the structural side, we will discuss this in the next few slides. But on the structural side, again, let's understand the direction. Okay, so yes, GST tribunals we knew were going to be set up, and but I want to pick this intermediary change or post sale discount change. Again, if you see the approach or the direction is to say that I want to eliminate friction. Both of these are friction points. They are unnatural conditions which are legacy conditions from service tax or legacy conditions from sales tax law, been there in the book for decades. Officer always doubtful about somebody going and giving a post-sale discount credit note and calling it a post-sale discount, but maybe for something else, and therefore never allowing a post-sale discount unless you announce it upfront, etc. To be bold enough to call out and say that I will respect what the trade is doing in the transaction is not a small change. It's a material change. Okay, so we'll talk about post-sale discount in a bit, and then finally the risk-based provisional refunds or the inverted duty structure refund. Again, inverted duty structure refunds were never automated at 90% provisional. Okay, it was always an assessment process. They've changed that. It's not simplification. It is a change of strategy. It's a change of mentality. It is a change on level of trust. Moving to risk-based provisional refunds is a change in level of trust, or is also a suggestion that I have big data. I know how to assess my risk. I know what are the problem statements or problem dealers that I need to examine closely, but why should I examine everybody in the same funnel? So directional change, right? Automated registration, directional change. We'll cover registration also, but again, very, very significant thought process around a tax officer accepting that you don't have a principal place of business in my state. Okay, there is no place where I can go and physically audit you. Okay, it's a disproportionate change. Please think about it. Okay, so we'll talk about these. So in summary, I would say that whether it is rate or removing legal friction or removing trade friction, I would just say this is step one. I am expecting that in step two, which is in the next GST Council meeting where the budget changes will get discussed, you will see a lot more structural reform. You will see a lot more trade facilitation that will come in because that is the way this is moving. It is moving to a trust-based system. It is moving to a more transparent system. It's moving to a more big data system. So we have to, this should not be lost on us. This is not a one-time change or a tactical change. This is very, very strategic. Now, the big picture we all know, I mean, what is getting cheap, what is getting expensive, what is moving to what rate. So I will spare this slide to the sectoral conversation. But let's go to the structural reform. So on intermediary, like I mentioned, there is a provision in our book which you all are all aware. This is 13.8b, which suggests that intermediary should be taxed based on the location of the supplier. So if you are an intermediary, which means if you're an agent of a foreign buyer or a foreign seller, because you are based in India, your commission gets taxed, irrespective of the fact that your services are otherwise export because you're providing services to an offshore client. Now, I've personally been involved in this advocacy for last about 4 years that we've been doing this. And interestingly, when you go to the origin, and not that I've seen any internal files, but you go to the origin of introduction of this clause in the GST place of provision of services rules in July 2012, it was because at that time, once the negative list came in, there was a massive export lobby which said that we pay sales tax. We are traders, we pay sales tax on our products, and we cannot claim credit of service tax. So if I have agents outside India who are helping me sell and I have to pay reverse charge on that, it adds to my cost. So therefore, let us create a framework where exporters are helped or protected. And that was at least what an officer suggested to me, the genesis of the 2012 change. And since the last 3, 4 years, we've been talking to the GST policy wing to say that now it has outlived its time because a trader can also take credit of reverse charge and services. So you need to reverse this. It took some effort on part of the government because we know there is enough and more litigation on intermediary. The definition being so expansive, there has been coverage for IT companies. There has been coverage for a lot of support service providers, call centers, various kinds of allegations have been levied. Uh, I got this very interesting snippet in one of my discussions where the bureaucracy had done a like a chart, a heat map of wins and losses on intermediary. And apparently there are some 147 judgments on this, which are all against the revenue. Okay. And zero in their favor. Uh, and they are obviously not counting advance ruling. So they started from service tax. I think maybe that also made them believe that this rule has outlived this time. So again, very, very good change. Uh, Takes away friction and makes it very simple. It goes back to the general rule. This amendment, of course, will be effective only when it is put in the budget and enacted. This is an IGST change. So after presidential assent, they can make it live sooner rather than later. But we'll have to see whether they wait for the entire GST, CGST amendment process to happen, or will they make this live immediately after presidential assent? Is a call that I think they will take at an appropriate time. On the tribunals, the uh, the latest is that the first from from actually my discussion earlier today, the first tribunal is likely to be set up in Thane. That will be the first tribunal of the country and in Mumbai. I mean in Maharashtra as well, and for the country as well. Yes, there is a principal bench that is loosely formed in Delhi, but for all matters, the first tribunal is likely to be set up in the next few weeks in Thane. And then later it will come in our Bombay jurisdiction as well. The idea, as we must have read already, is to make the tribunal completely digital with even all the submissions to be made only digitally and not physically, and the hearings also to happen digitally. So quantum leap, it will of course take its own journey of settlement, but a quantum leap. They are setting up infrastructure. I was with the Commissioner Thane earlier in the day and said that we are setting up state-of-the-art infrastructure. to make sure that no taxpayer has to travel to appear. And we will be able to achieve that when we go live. So it's quite commendable. You will see more and more tribunals getting announced now that the members have been shortlisted in the next 3 to 6 months. And maybe by end of December, we will have tribunals in all major locations that they had announced already. So good, positive for us to move forward on the past litigation. On the post-sale discount that I mentioned, and the fact that it is a seminal change, the most interesting aspect of this change, if you think about it. So before we go to that, let's take a simple case study. I'm a phone manufacturer, and I price my phone at 50,000 rupees. It's on the shelves. It is getting sold. Now it is about 8 9 months, and I come with version 2. Okay, or it's been a year and I come with version 2. Now, when I come with version 2, 50,000 is my price point. So I would like to keep the new phone at 50,000, version 2 at 50,000. But then I have to sell version 1 at 35,000 because otherwise version 1 will not sell. So nothing wrong with the phone. But from a market standpoint, I have to reprice version 1, right? Very common. We see it all the time. We buy all the time these strategies, right? So the challenge was that the embedded GST in this 15,000 rupees gets lost because I cannot announce this upfront. So I cannot tell a dealer that this is how I will strategize. This is when I will launch the next phone. This is the price point at which I will launch. And this is the price that I will determine for version 1. You cannot launch it at upfront in that manner. It's not possible. So if you see our conditions say that you need to pre-announce any of the discounts that you want to give if you want to be able to give a credit note. This has been changed and a new circular was issued just a couple of days back, which is now saying that uh, you of course can continue financial credit notes, there is no problem, but you can also take an adjustment for post-sale discounts. And then there are certain conditions that have been attached, which is quite logical. Uh, if you see bullet 2, it's from the bottom, it says that the manufacturer and dealer, if they are doing this transaction of 15,000 rupees amongst themselves, there is no problem. But if the manufacturer is giving a direct incentive to the consumer and the dealer is only a pass-through channel, then the conditions are different. Okay. So this is one exception that has been made out. The second exception that has been made out is that if the manufacturer is giving this 15,000 discount to the dealer, it's fine. But if the dealer in lieu is agreeing that he will set up a kiosk, he will give a special area to the manufacturer, he will put a salesman specifically for that manufacturer, then the 15,000 is possibly consideration for additional services that the dealer is doing. Now, this element was there in Circular 212 2024 as well. The more important aspect, if you read this, both these points, which is para 2 and para 3 of that table of the circular carefully, uh, both of these emphasize the need for a contract between the dealer and the manufacturer to behave in a particular manner, not a presumption of a contract. And that is the important change. So today, all the litigation that is happening at the dealer level that you're rendering service for which you've got a discount, if you closely review those notices are presuming that you've got this 15,000 rupees because you rendered a service. And they are reading the promotional scheme of the manufacturer to suggest that this is the inducement that is being provided to you, and therefore you're agreeing to do an act and not do an act, and so on and so forth, right? So that is the direction in which they are trying to take us to collect tax or demand tax. What this circular is changing, and that is why it is significant, and that is why it is not limited only to discounts now, is that it gives direct critical importance to the contract. It says we have to look at the contract. There has to be a contract and an agreement of minds to behave in a particular manner. And only then this will be taxable. As long as there's no contract, you cannot establish that there is a handshake. Then to presume that one party is reacting to other party's inducement is incorrect. The circular doesn't say this, but this is the conclusion we can draw. And therefore, in many other cases where there is an allegation of presumption of existence of a contract, okay, this circular will help us. Let me give you a very interesting example. Some of you may have followed this litigation of service tax era, where there is a litigation banks are facing on minimum balance charges. So the litigation says that the show cause notice says that if a customer agrees to maintain a 5,000 rupee balance and he does not maintain, then you charge a minimum balance charge. On that, you pay service tax. Okay, so fantastic. But if the customer actually maintains that 5,000 rupees, then you are giving him, because of that 5,000 rupee balance, let's say 4 ATM withdrawals free, one checkbook per 3 months free. Okay. So these free services that you provided are in lieu of the minimum balance he is maintained. And if we read the show cause notice, the show cause notice is saying that the customer is agreeing to maintain a balance to receive free services, and therefore the customer is induced to maintain this balance, which he's agreeing to provide as a part of the contract, and therefore he's agreeing to the commitment to maintain a balance, which is a service, and for which the bank is providing free services. I'm just giving you a simple example of how revenue has been able to stretch some of the transactions to presume existence of supply or agreement to supply. This circular will help us in all those cases because it's directly linking it to contract, it links it to mutual understanding. And when I'm doing this 5,000 rupee with the bank, I'm not entering into a contract to say, okay, I'm induced to maintain this 5,000 rupees because you're giving me 4 withdrawals, right? That's not the contract. That is a product feature. If I buy a 1 lakh rupee phone, I know the product features will be different. Of the same company, if I buy an 80,000 rupee phone, which is a slightly lower version, I know product features will be different. So I'm buying into a product feature. I'm not saying that, okay, this 20,000 is because I've agreed to use a better camera and I'm induced by the manufacturer to use a better camera and therefore I'm doing what I'm doing, right? So I personally feel that this is a significant plus. There will always be challenges in anything that you write on some of these topics. So there are some chinks in Circular 251 as well, but that always is the case. As long as we are able to leverage the principle, we are home, right? Trade facilitation. I briefly touched upon this. You look at the 90% sanction or provisional sanction that has been talked about. They're talking out based on risk assessment. Now there's a significant effort since the last 1 to 2 years that is happening at the back end to create a risk assessment framework for all taxpayers. So I think this is a part of that. The minutes of the meeting, or rather the press release, does not talk about it in that manner. But my assessment is that this is an outcome of all the effort that has happened on analyzing data and the reports that GSTN is able to generate. And we will see more parameters being shared with us of how this risk is being assessed for us to self-assess how we stand. So, but again, think about it in a different way. I am extending this to what I'm expecting next, which is why don't you select me for audits on this basis? Why don't you ask me questions on this basis? Right. So just analyze my data, ask me only relevant questions, or select me only for relevant years when I have to get audited. I don't have to sequentially get audited for every transaction for every year, because then you're spending too much administrative capacity with the same set of taxpayers and you're not able to assess if there are any people who are on the fringes, right? So this is directional again, very, very useful. And if this becomes a success on refund, I will not be surprised that in 6-8 months time you will see something on assessment on this. Okay. 54.6, uh, I I'm really happy. At least none of us expected 54.6 change that is proposed will happen. This is going to be effective. Both these changes are effective 1st November, but 54.6 will have to be amended in the Act. Rule can be amended from 1st November. 54.6 will have to require a parliamentary approval, so it will happen only after maybe 12 odd months. Having said that, they've said that we will issue instructions and tell field formations to start granting. So again, strong, positive, good change. Inverted duty structures getting refunded provisionally is an achievement to my of many in many ways. Uh, because if you look at any inverted duty structure refund process that if any one of us has been a part of, uh, the formula is quite ambiguous, and B, every officer creates his own interpretation of what is eligible and what is not. So if it is a first assess and then give refund process, it will always be how do I not give a part of this refund? But if it is like an export refund process, then the speed at which trade will benefit from a cash flow point of view is significant. Yes, this does not take away the fact that if more than 10% of the refund is denied, then it will go in litigation. But it may be, in the way I look at it personally, is that it's okay to fight a litigation, but have the money right now rather than lose the time value of money as well, and then get the refund with only 6% interest. So again, very good positive change in my assessment. Now, registrations. Uh, so getting registrations quickly, low risk applications. We know, this will be good. 2.5 lakhs per month. Uh, I think the more important one is these ECOs, electronic commerce operators. Uh, it is not that they've come out with what the strategy is yet. Okay. But they have suggested they will simplify this. Now let's take an example to understand this. I am on an electronic commerce platform, which is an app or a website which has multiple sellers. And then I obviously consumer searches a product, my product gets selected, I become the supplier, I sell the product. Now we are all now used to 10-minute delivery, but otherwise at least a T+1 delivery. For any website to be able to give you a T+1 delivery, it will need to create multiple stocking points in the country. Otherwise, if we as people take so much time to reach from one place to the other by road, for goods to reach will take forever. So there will be multiple stocking points, and through technology and big data, the platform will know which goods are in popular demand. So let's say I am a phone reseller. I'm importing and selling certain phones, or I am a laptop reseller, or I am a, let's say, power bank reseller. And I know that this power bank is in demand. It doesn't get made in India, but it's in demand. It's a very good quality product. And therefore, typically all the metros or tier 2 cities will order this at least 100 pieces a day. Now, in that case, the platform will tell the seller that this is the stocking that you need to maintain across the country. The seller may be only in Maharashtra. He may have only one office, but he will, of course, stock in multiple places. Now, when I go and stock in a Gurgaon warehouse to service the NCR region, the challenge I face is how do I take registration there, because I'm keeping my stock, and we know place of business includes place where we stock the goods, and I'm then supposed to charge C plus S if it's a Gurgaon transaction, or IGST from Gurgaon to Delhi. Similarly, the previous step in the chain, which is when I imported, post import, I have paid IGST on imports. I want to use that import duty and transfer it as IGST on goods to Gurgaon so that I can use the credit when I sell those goods, right? So For that, Gurgaon registration is mandatory. For any registration, having a principal place of business is mandatory. And if you understand the way these warehouses work, there are 10,000 sellers who have their goods in this warehouse. And those goods are stocked based on efficiency and not based on premises. So you don't get an earmark place. My 100 power banks will be lying in some corner of that warehouse, which are very large warehouses. And therefore, for me to call out any fixed place as my place of registration is impossible. So then I may go to a chartered accountant office, or I may go and hire some small office in Gurgaon to take my principal place of business registration and take this warehouse as my additional place of business. Uh, this limits my ability to expand my business. And most of the sellers have been pitching for this for a very, very long time, of the need for changing to say you can have one PPOB, principal place of business, in one state, and then all your APOBs, which is additional place of business, in all other states can be linked to that PPOB, one PPOB. Okay. Uh, when you look at it from a state lens, it's very hard, because where will they go for audits and assessments? They can't go to the platform warehouse and say, oh, I want to audit this particular seller, give me the books, give me the purchase invoices, give me the set off, give me the reconciliation, give me trial balance. The warehouse is not going to entertain any such audits. So the state feels a risk of loss of power to assess and determine what is the tax to be collected. This is the reason APOB was not being accepted and PPOB was mandatory. This sentence in this summary in the document is a clear indication that they are changing this. Very big change. Think about it. You're going to tell Haryana that you have no place where you can go and assess this power bank seller. You have to rely on the data that is provided with an additional place of business in a warehouse of a third person, which is a platform. How well will they be able to achieve this? How easy is it to implement this? Uh, I am a skeptist about it, knowing how insecure sometimes states get on assessment, and rightly so. But putting this out in the press release is definitely a clear indication that this is coming. So I would not be surprised if I'm expecting this to pan out from today's situation to a better situation, which is that if I have goods in Gurgaon, I can take it as an additional place of business, link it to my principal place of business in Maharashtra, and the Gurgaon authority will have the ability to seek information from Maharashtra, right, which is my main office. Some of that framework might get created. So that's, I think, the situation that I'm expecting. I'm I'm asking for something even more. I'm asking for something which may be that if I'm a seller on this platform, I should be considered automatically registered in all warehouses. Because why force me to go for an APOB registration in all the states, one by one, sequentially, when you're not going to be able to come and audit me? Okay. Rely on the information that I'm filing. Yes, I will take a registration. But instead of asking me to file for a registration, give me registrations in 20 states in one go if I ask for it. Appoint an administration that will review my activities separately. I have no problem with that. But imagine the speed at which I can grow my business as a small trader. If now I can sell the same power bank in 20 states because I have a great source, I have a great price, I have great customer reviews. But today I'm stuck because of the PPOB APOB problem, and I have been able to reach only Gurgaon and possibly Bangalore. But I would want to sell all India. I'm selling, 500 pieces a day. I want to sell 50,000 pieces a day. Okay. So that is the meaning of this change. And so it's not a change in registration to my mind. It is an opportunity to catapult for several small suppliers. And if this indeed happens in the in the best manner that I was currently stating, then again you will see a directional change in how some businesses will grow. So very meaningful. That's why I said in the beginning that uh, some of these changes are at, if we go deeper, we can see a lot more meaning to the change, and a lot more long-term impact of the change as compared to what just appears from plain reading. Right. So that's our section on the significant two topics of strategic changes and trade facilitation measures. I'm going to move now to the transition provisions. The transition provisions are enshrined in section 14 for us. And I'm sure all of us have studied it, so I'm not sort of going into discussing the section and the law part of each one of them. We know there is a 2 by 3 test that has been given, and there are three events, which is the invoice, supply, and receipt. And we have a framework which is there in section 12 for goods, section 13 for services, and section 31, which is the invoicing section. If we read all of them harmoniously, we will always get the right answer. Okay. Will the combination of 12, 13, 14, and I'm including goods and services both, so 12 for goods, 13 for services, 14 for transition of goods and services, for rate change, and 31 for invoicing. Will there be corner cases where the application of law can be pushed one way or the other? Yes, there are corner cases that are emerging. Okay. Uh, but I can tell you that in most situations you will find, and I will go to the extent of saying in all situations you will find something which is rational and logical, and something which is looking aggressive. And then if you see at least I have my assessment of the mood of the trade is nobody wants to be unnecessarily aggressive, because this is a 15-day game. But there's therefore more downside of litigation in the long run rather than upside of winning some market. If this was a very long-term play, then you would have made a differential market share gain. But in 10, 15 days, it's just very tactical. It's not strategic at all. Having said that, uh, from a principle standpoint, the slide covers it that there are three events: issuance of invoice, supply of goods or services, and receipt. Let's consider goods first. Section 31 helps us understand when the invoice has to be issued. So if you look at section 31 for goods, it says when the goods are dispatched, we need to issue the invoice. Uh, the supply of goods will be relevant for certain categories of goods where there is a deferred supply, or there is a sale on approval supply, and there is a sale on approval case study that I'll cover. But in general, if you read 31 and 12, supply of goods and issuance of invoice typically will be coterminous in goods. Receipt of payment can be before or after. We had an era in the first 3 months of GST where advances of goods were also liable to tax. But then they abruptly stopped it and they went back to what was there earlier, which actually was the right thing to do. And so receipt of payment is uh, in a normal simple supply transaction an unlikely parameter to determine the rate of tax, because if issue of the invoice and supply of goods is happening nearly coterminous, then two events are already clubbed. So whichever side of the September 22nd date you are, you will know the answer. Okay. Uh, I'll come to sale on approval in a bit. But when I then look at services, on services, this becomes a little more complex. So I would urge everybody to think through in some level of granularity on what really is supply of service, and is the date on which, let's say, I give a statement of my work done, is that the date of supply of service? Is the date when I commence work, is that the date of supply of service? Is the period for which I've done the work, is that the supply of service? Uh, so there will be ambiguity in determining supply of services. Issuance of invoice is not as hardwired in services as it is in goods, because it is again linked to within 30 days of supply of service. Supply of service being ambiguous, issuance of invoice date also therefore is not a point in time. Receipt of payment is the only clear transaction here. So if you see goods versus services, in goods, receipt becomes practically irrelevant. But in services, receipt is the only truth. And the other two uh, are unclear, to use a generic term, uh, because not because you don't know when you issue the invoice, but because you don't know what is the date by which you should have issued the invoice. That really is the crux. Because then, otherwise, I could just issue all invoices after the cutoff date and get the lower rate if there is a lower rate available. Or I could issue all invoices prior and get a lower rate if the rate is going up. Uh, but it's not the case. So when we come to the services section, I will pick this up. There is an FAQ that was issued simultaneously when the press note was released. There is some discussion on time of supply on that, which is a little vague. And I would take the liberty of saying that there is some error also committed in that. But if you see the subsequent sentence to that FAQ, they've clearly said, please rely on section 14 to determine the outcome. So we should not get colored by the FAQ. The FAQ may have been generically drafted and not really specific. Even if the FAQ tells me that you have to just go by receipt uh, or just go by invoice, it will not help us because the section is absolutely clear. So relying on the FAQ to determine the rate of tax may not be wise, uh, especially for goods. For services, I would say that I'm expecting more FAQs to come, and we'll look at a few case studies when we talk of services. Uh, but again, while there is some room to play, being pragmatic is a better approach than being slightly more bold in moving time of supply from old rate to new rate and vice versa. Right? So that's the rule. But now let's take a case study, and I'll give you time to absorb this. But I'm considering, let's say, an impact on sales on goods. Captured 5 transactions here. If you see column 2, we are supplying goods to distributors, or we're doing interstate stock transfers to our depots. Then the goods are supplied from the distributor or depot to the retailer. So those are the 3 steps on the first box. The second is that goods are sent on sale and approval basis, and the approval is received after 22nd September. And the fifth is the approval is received before 22nd of September. That's really the case. Now, because my fourth column, which is the date of dispatch, connects me quite strongly to the date of invoice, irrespective of, in the first 3 cases, irrespective of date of receipt or for the goods. If you see column 1 and column 2, which is date of invoice and date of dispatch, for the first 3 cases is coterminous. Date of receipt is different dates. But because the 2 events are determining the outcome, my rate outcome is directly linked to date of invoice / date of dispatch. When I come to the fourth and the fifth, the answer is different. So we understand sale on approval. There is a special provision in time of supply for sale on approval. So if the goods are sent on approval, then the date on which approval is received becomes the date on which you have to raise the invoice as per section 31. And therefore that influences your time of supply. and the time of supply gets linked to when the approval is received. So it's now not getting linked to date of dispatch and date of receipt, but it is getting linked to the date of receipt of approval. So very interesting and unique from the 2 by 3 test. Um, I have seen a lot of discussion on this topic to say that can I therefore uh, move goods on sale or approval and choose the new rate by taking customer consent in a particular manner, and therefore I have to raise the invoice only after September 22nd. Okay. Uh, Theoretically, on the whiteboard, if you draw this in a slide, if you put it as a case study, the answer is simple. And therefore, the answer is in front of you in 4 and 5. From a on-ground standpoint, the most important caution that I'm advising my clients is to say that A, please understand the nature of your goods. And are they, from a business standpoint, typically considered as items of sale on approval? Okay. I manufacture shampoos, the rate on shampoos is going down. Can I give my shampoos to the distributor on sale on approval? Okay. And what approval is he going to give? What assessment is he going to do on those goods to approve those goods? So, are those goods in the nature where sale on approval can be explained? And second, as a business, have you been following that practice or not? So, have you really had sale on approval cases, even if there are a few? Have you had sale on approval cases? What are the reasons for that? Are these cases comparable to that? Okay. And the third, which you write in white ink, as it is said, is that the problem will be that you will do this only for 15 days and then you will again go back to sale and stop sale on approval. And these are therefore, like I said, these are uh, when you are thinking it from a textbook standpoint, possible opportunities, but from an on-ground standpoint, are these really opportunities, or these are good for conference room discussions and few biscuits and a coffee, but is it worth taking a risk of creating a tax shelter for a 15-day window to gain some tactical space? That's the assessment I would ask my clients to do on the sale on approval discussion. Credit notes, now credit notes behave differently from the time of supply that we have seen on goods, and rightly so. Credit notes will be linked to the rate which is charged on the original invoice. So if you see the third last column and the last column, they are exactly the same. Okay, in all scenarios, the old remains old and the new remains new. So the simple message on scenarios of credit note is that credit note is not going to get governed by Section 40. Credit note gets governed by the tax that was charged, because you're calling out in Section 34 to say that the tax that I was supposed to charge is more than what I have charged, or tax that I had charged is more than what I was supposed to charge. And therefore, I'm issuing a credit note. So when you do that, you have to compare it with the tax that was charged and has nothing to do with the current rate that applies on those products. Okay. But if you see the footers that I've added, clearly you will have some challenge in relation to reporting, especially if you are the 12% rater product, which is going down to 5. That will they allow a 12% reporting line in, because now funnily it is first the technology, then the circular, then the rules, then the act. So we are pretty much working in reverse direction in many situations. So this could be one of those that the technology doesn't permit you to report a 12% credit note, and then you are stuck. So you have to be mindful of that, and of course file a representation, whether through the BCAS platform or any other platform, to make the government aware that the GSTN need not switch off to 12% rate, because the long tail will continue for some time. And the second part is that if you are indeed giving a 12% credit note with a product which is taxed at 5%, if you are a very thin margin company, then you at the retailer distributor level, you may have an inversion. What is the extent of that inversion? And the complexity needs to be seen. Complexity may vary because some states may not be very dominant for you, and therefore in those states you may have a problem. In the main state, you may not have a problem. So those are the two or three main points of credit note. Rate does not change. 12% reporting, please watch out for. And whether it's creating some sort of inversion or not is something that we need to watch out for. Of course, the other big piece out there is IMS, but this is not a session on IMS. We've already had a discussion on IMS a few months back on the BCAS platform. But yeah, credit notes is a big problem in the IMS world as well. On purchase of goods via import, uh, the the time of supply is linked in a way to your bill of entry. Okay. And it is not linked to the supplier's invoice. So the bill of entry triggers what is the point when you are paying the tax. So just focus on that. That is not changing. Your supplier may have invoiced or dispatched. The supplier is not governed by GST, and therefore we should focus only on the bill of entry. So that's a simple message in relation to import of goods for purchases. And on job work, the impact is more to do with uh, capital goods sent to job worker but not returned. These get deemed as supply, and there is a need for invoice to be raised on the expiry. So this invoice, if you see the provision, says that you need to raise it on the rate applicable on the date of removal, not on the date on which the period expires. So if it's a 12% rated product, if it's a 28% rated product, then you have to pay 12, 28. You can't pay the new 18 or 5. So you'll have to be again mindful of that. But when he actually finally sends it back to you, the rate applicable on the date of removal applies. So he will suffer a lower rate. So job work may have some transition issues for spillover cases. We just need to be mindful of that. Yeah. So this was the time of supply discussion, which is quite intense in many ways for all of us. Now, I'm going to just speed through some headline messages on some sectors because we otherwise, we'll spend too much time. There are 8, 10 sectors that I'm covering. But just to give a flavor, this is our, favorite and most popular, and there are multiple changes across multiple products. So we know what is happening for each of our products. Yes, the Harley Davidsons of the world are getting more expensive than before. But otherwise, if you see, in all cases, the rates are going down, and which is a strong welcome change. If you look at the industry impact, uh, clearly this is an impetus for the fringe purchasers, the ability to buy a slightly higher version or a slightly higher price car because there is around a 10% rate reduction that is coming our way, so which is very strong. Classification disputes will certainly go down or end in this sector. Most of the classification disputes are related to the classification between 18 and 28. Now all components and parts are at 80. And because of that, classification disputes will go away, and which is therefore a very, very strong positive for this sector. If any one of us have had experience in auto industry classification disputes, these are very, very nuanced, and sometimes based on the number of bearings in that part, the rate changes. So it's very highly engineering driven classification and not necessarily just the commodity that is used, or the metal that is used, or the component that is used to manufacture that product, right? So very, very strong, significant shift from a mentality perspective. This will also affect imports or benefit imports and reduce import litigation. The uh, the biggest challenge of this sector is compensation cess. So consider the fact that there is inventory that obviously lies across the market, and most cars were suffering compensation cess, or most commercial vehicles were also suffering small compensation cess. So all these compensation cess is lying in the inventory because the manufacturer would have paid them, cleared that, with the hope that when the dealer clears it and buys and sells it to the buyer, he will again charge compensation, says utilize the credit, it's done. Now, with the extinguishment of compensation cess from 21st September and a new rate of 18 or 40% applicable, you are going to see a challenge, or we are already seeing a massive challenge, that the dealerships will be stuck with cess balances, right? Compensation cess is not a small revenue. It is 1,25,000 crores last year for the government. Primarily, it comes from 3 or 4 products, and therefore it is material. And the auto sector bears a significant component of that. So if you take 2 or 3 months inventory and determine what is the amount stuck, it may be upwards of 10,000 crores. If that is the amount of money that is going to get stuck, then somebody will have to take a hit. Now, who will take a hit? How will that be priced? Customer is obviously not going to pay compensation cess. In fact, customer is delaying purchases because they don't want to pay the higher tax. It's very natural. Uh, so this is an industry issue, a lot of government conversation going on, and hopefully some resolution will come up on compensation cess. Uh, on anti-profiteering in general, I have a slide in the end, but anti-profiteering, the government has taken a very good stand to say that we trust the industry and market forces. We don't want to bring in 171 back. I think that is a step in the right direction. There is enough competition in most products and services, and therefore, I don't think there is any space to pull the market and make the consumer pay inclusive of tax the same price. So, uh, and I would think that if some of you saw the notification that came out 3 days ago, the government has listed out some, I think, 120 commodities, of which they are monitoring the prices. So while they are not implementing anti-profiteering, but they are suggesting to industry that we are looking at this, and so you please make sure that you pass on the benefit. So that's the story of the auto sector. Furniture, there is overall rate reduction in tableware, kitchenware. I think the directional throughput here will be, because this 5% rate is with input tax credit. I think the directional throughput here may be to start getting more and more small, medium enterprises on board, and there may be a lot of leakages on the fringes, which now should stop happening, because if you get 5% with ITC, you're pretty much not going to pay any cash tax. So the government gets to see the full value chain, and that may be the benefit of changes in this sector. Packaging, 12% has generally gone to 18%, especially except for basic corrugated boxes. But because this is the B2B segment, it may not significantly impact uh, the uh, the sector. The sector will be able to pull through all credits, including capital goods credit, and then pass it on, and the other side will take credit. Yes, for biodegradable packaging material, there is a 5% rate, and that will encourage people to look at alternative packing, especially if you're an exempted product. Then you will look at the alternate packing. So which is a which is a good shift from the current rate of taxing everything at 12% or 18%. Pharma, again, across the board reduction, strong messaging in reducing healthcare cost, improves affordability, no doubt about it. Uh, the big challenge for pharma and FMCG, and we read it every day in the press, is about repricing, restructuring. How do I comply with the DPCO guidelines? How do I comply with the legal metrology guidelines? And how do I resticker so many goods? How do I reprice them? I have in a sweet spot of 5 rupees and 10 rupees. I can't price it 4 rupee 90 nobody buys in that manner, and the cost of restickering will far outweigh uh, the uh, the passing of benefit that I want to give to the customer. At the same time, if I flood the market with the next pack of 4 rupees 90 paisa, 5 rupee packet will not get sold, right? So it's a challenge. Businesses are thinking of a lot of innovative ways of handling this. For example, can I increase one biscuit in the packet and keep it at 5 rupees, and then give the benefit as grammage and not as price, because then the effective per unit price has gone down. Uh, so a lot of interesting times and challenges for businesses and of course for their advisors. So we need to be sort of plugged in and work with them in this opportunity. A An impact for both pharma and some FMCG is the impact on state incentives. State incentives are in many states, including Maharashtra, linked to the SGST that you pay on the product sold. So you get a refund of the equivalent SGST amount. But consider these situations where you are paying 18% SGST or 9% SGST or 6% SGST. If that 9% is coming down to 2.5%, then the propensity of consumption of SGST refund goes down dramatically, less than a third, right? And if that happens, then you may have projected a particular cash flow from the government as an incentive. That is how you would have priced your product and made your project viable in a D category zone, let's say in Maharashtra. Now, does it remain that lucrative? Or will you have to now sort of maybe renegotiate with Maharashtra or re-engineer some of your processes to cover that gap? The SGST reimbursement can be very, very significant component in the amount of incentive that the government gives to trade to go to backward areas. So this has become a problem that needs a lot more work to be done. MRP re-leveling we spoke about. Construction sector, again, directionally, very good changes. And it is reduced taxes across the board, cement being really, really significant as a change. And therefore, it it's a certain positive. Turnkey contractors will not get an impact because turnkey contractors are works contractors. They pay 18%. They get credit of everything. They have a margin. So turnkey contractors or works contractors do not have a problem. But developers will definitely see cost saving. If they are directly doing the procurement themselves, you may see structures change for developer-led procurements in certain cases. So the rate rationalization will help industries like civil construction, data centers, which are coming up in a big way. There's a data center policy that is going to get announced. So good traction should happen on the civil side with these rate reductions. On textile, again, reduction in rate, good change, but the challenge will become inversion. Textile will face inversion, so that may create complexity and may require discussion whether all of the inversion is only because of inputs and capital inputs rather, then inverted duty refunds are available. But if a lot of the inversion is because of services, then you have a problem of not getting the refund. So wherever inversion is happening because of services, companies are thinking of insourcing those services and hiring people to do it rather than hiring a service provider to reduce the inversion. So lot more changes being done in the business model than just change in rate in the system. In the energy sector, the headline is that we have in solar and wind, we have a 30/70 formula for goods and services and goods, which has been prescribed. This structure was, this was changed from 5 to 12 in 2022, when the rates were moved from 5 to 12. Earlier, they were 5. And my effective tax rate was about 13% on inputs, and it was still inverted because it was 12% on output. Now with the 5%, it becomes effective tax rate becomes 8.9%. But I'll still have an accumulation. And if I have accumulation, then I will go for inverted duty refund. Uh, but the capex cost will go down for the industry. This will give some impetus to energy sector investments, to captive power plants. The GST on coal has gone up, and that will mean that alternate energy will see more investment. And coal cess is a sister of compensation cess, that coal had cess, 5% plus cess. That cess is now sort of stuck somewhere. It needs to be resolved, but it becomes 18%. So the 400 rupee per ton cess is a challenge from a transition perspective. But from a cost and effective rate perspective, 5% plus 400 rupee ton assess is pretty much similar to what is 18% tax. So it's good they're doing away with cess. It's a cleaner structure. And they're also indicating that thermal power will be more expensive than solar power or wind energy, which is a good way of going about it. All these are with input tax credit. So it's not a cascade. It will just lead to inverted duty refunds. Yeah. In metals and mining, coal cess is the big thing. The rest is pretty much, and cement is a big thing for construction. Logistics, I'm just going to come to in a bit, so not major impact in this sector. Agri rates have gone down everywhere. This is definitely a good change. There were the great caramelized popcorn conversation that happened, or the roti versus parota conversation and the advanced ruling that happened. All of that is now killed. So food products, agro products, a lot of this is largely now 5%. So it's become much easier. On the services, insurance is a big change, quite a significant change. The If you remember in the opening, I did mention that they've not clarified as much or as well in the service sector as compared to the goods sector, because in the goods you are seeing even HSNs being prescribed, but in services, this is what you have. So if you see my table, it says all individual life insurance along with reinsurance thereof, and all individual health insurance along with reinsurance thereof. Now, interestingly, the term individual or life insurance or health insurance are not defined in our law. Okay. So, what is individual life insurance and individual health insurance is a big question mark. If we look at health insurance as an example, we may consider a health policy that we take or a family health policy that we take as health insurance. But if you see the IRDA relevant regulation, which is the Insurance Act 1938, health insurance also includes personal accident insurance and travel insurance. So the question therefore now is that what is the intent of this coverage? And this is a representation that has already been filed to explain or to seek an explanation or a clarification on this, that what is going to be exempt. Is it health policies or is it personal accident policies and travel policies as well? We are expecting a clarification very soon, and I think it will get clarified in the notification. Maybe they link it to the Insurance Act definition and that simplifies the matter. Second is the meaning of the word individual. Okay. Or before we go to individual, which is common for both, let's go to life insurance. So, what is life insurance? They have in the narrative explained that it will cover term life, ULIP, and endowment. Okay. But will it cover annuity and pension plans? And that becomes a question mark. So, if you see our SAC codes, the SAC code will cover all kinds of life insurance. But in the press release, they are only talking of three types. So, is all life insurance covered? Or is it only these three types? It remains to be seen. Again, my view is that they are likely to cover all. The press release was uh, and like a communication of discussion and not really the notification of the discussion, right? And then you come to the question of individual. So what is individual? Is B2C individual? Is B2B not individual? Uh, I may be I may be a proprietor and I may have a GST registration number. And I may give my GST registration number to my health insurance person, may not give. Same for life insurance. Then am I a B2B transaction or a B2C transaction? I may be a mid-sized company, but because I don't get input credit of health insurance, I may not give my employee policy related policy number. When I take that policy, I don't give my GST number. Does it become exempt because it's now B2C? So these questions have been raised. And again, the government should come up with a clarification. There was yesterday some indication in the FAQ that came out to say that this is only for insurance sold directly to individuals and to including family floaters, and it does not include group products. So that is a welcome clarification. So which means if there is a policy taken by an employer for their employees, or if it is a policy taken by a non-employer under a master policy framework for all the certificates of insurance issued under that policy, those should continue to be taxed and only direct insurance will get exempted. Now, we will see how this gets clarified. But it is expected that this insurance exemption will come in two parts. Some will remain taxable, some will be exempt. So it's important to understand what is playing out. Reinsurance has been exempted, but the commission has not been exempted. So once you exempt a sector, but you don't exempt their input costs, then there will be a cascade. This cascade will therefore affect the price at which insurance is sold. So if I was paying a premium of 100 and 18 was the tax, I was paying 118. I will certainly now not pay 18, but the product may be repriced to 104 because the business is losing input credit. So that therefore you will still save on a net basis, uh, but certainly there may be some lift in the price of insurance, base insurance. On logistics, most of the rates, like I said, have gone to 18 with ITC or 5 without ITC, and it's become simpler. The 12% rate has been sort of disbanded, so effectively 12 has become 18 with ITC. It's a B2B service, so it should be okay. One material change is the last one, which is local delivery services through ECOs. Uh, what is this local delivery service? Needs to be defined. It is not defined as yet. In the FAQ, they've tried to clarify yesterday, but they still haven't defined it yet. Let's take my assessment of what is likely to be covered. Let's take the example of these food delivery apps that we use, where you are getting a local delivery charge of 30 rupees, 50 rupees for making the delivery. Or these instant delivery apps that we're using, again, we are paying local delivery charges there. I suspect that they want to cover that. That is the reason why they put it under Electronic Commerce Operator 9.5. What the FAQ of yesterday says is that if a local delivery charge is levied through an electronic commerce platform, then 18% tax will apply, which will be payable by the platform unless the delivery person is registered. So I'm a professional manpower supply or delivery services company. I'm a courier company, let's say. And I tie up with, for my people, I tie up with a platform, food delivery platform to provide my people for delivery because my courier work gets done by 4 o'clock in the evening and therefore I have free capacity. Then because I am a GST registered person, I will charge GST to that platform at 18 rupees for all the work that I'm doing, which I may be already charging actually. But if I'm a freelancer working as a delivery boy on the platform and I'm earning 30 rupees, let's say, as out of the delivery, I may be paying some platform fee out of that, but I'm earning gross 30 rupees. That 30 rupees was not getting taxed. With this local delivery services through ECOs, that 30 rupees will get taxed. So this is a new tax that will get collected. This is a new category. If we were in the positive list era of the good old days of service tax, this is a new category of service which will get taxed, where some revenue or a lot of revenue will come over a period of time, because we know this is become an integral part of our lives. Yeah. Uh, I think these are just a little more granular details of logistics. So yeah, I think, yeah, renting a motor vehicle is fine, but leasing, I have a slide on leasing, so I'll come to that. On job work, the rates have changed. So we know the rates. Local delivery we spoke about, so I'm going to skip that. If you look at other services, I want to only talk about two items, which is the vehicle leasing and the hotel. So on vehicle leasing side, the concept is that on lease, applicable asset rate applies. Similarly, that concept continues to remain the same. Applicable asset rate will apply. So if it was 51% or 48% in the past, lease rentals are suffering 48% tax on a month-on-month basis. So what has the leasing company done? They have purchased the car, they have paid 48% tax, and now they're using that 48% over the next 3 years against lease rentals. Out of the 48%, 20% is compensation cess. Consider the same problem. Now from tomorrow, they have to charge 40% GST to you, which they will charge. So for the lessee, the rate of tax goes down from 48 to 40. But for the lessor, he doesn't know what to do with his compensation cess credit. And that is an add-on challenge in the auto sector, that all the vehicles that are on lease, consider all the employee leasing policies that we have for, let's say, income tax perquisite planning. In all those cases, leasing companies are negatively impacted. Will it impact the lease rentals that are being charged to the employees remains to be seen. And for hotel accommodation, for rather hotels with a tariff below 7,500, the restaurant in that hotel was earlier with the option, had the option of 12% with ITC. Now that option is taken away. So while there is a rate reduction, there is no option to pay tax. So I come to my summary. I know we're pretty much at the end, or we're just about exceeding time, but I'll quickly summarize. So when I look at a manufacturer, uh, the positive impacts are rationalization and consumer demand. Complexity goes down. The challenges clearly are input accumulation, old inventory, transition, billing system update, compensation cess, etc. When I look at a trader, it is primarily the transition that is an issue that they have to deal with. And how do we deal with both sides of the table to get it right? I think most of these points are covered. Incentives we have covered. On pricing, one can write a thesis of all of this. How does it affect price, and how will they be passed on? For example, if you see the third bullet, it says, can you do price reduction, discount schemes, increase in grammage, combo pack? Can you give post-sale credit notes? retail level discounts, some schemes announced in newspapers. So how do you go about it is the problem. And then what will be acceptable on ground will also be a problem. So to wrap up, these are the six big areas of work. First is the input tax credit, the accumulation, the loss, and the focus on internalization and efficiency to reduce loss. Second is state incentives. Third is inverted duty and how do you leverage on the rationalization that they're doing of the trade facilitation process, as well as how do you limit your inverted duty structures. Fourth is anti-profiteering. How do you meet the requirements? Fifth is inventory transition planning, and third is last one is other laws that apply to you. You may be governed by the insurance regulation, the legal metrology regulation. You will be sort of have to have a perspective on all before you take any final decision. So that's about it. And so what you need to do is way forward, system readiness, pricing, trade agreements. Some trades agreements will get renegotiated. Some pricing will get renegotiated. Some transition agreements will come up. So advocacy is big. Government is listening. There was a 3 day Wednesday, Thursday, Friday last week where I think they met some 20 plus associations and they heard the concerns. And one FAQ has been released. One more FAQ we expect to be released in 2 3 days time. So talk to the government, file with the GST TRU team or member, tax policy, and you should be able to see some traction on your matters. Transition planning, planning or assessing risk of loss of ITC and state incentives and subsidies. So that's about it. Hopefully, I'm on time, or maybe I've exceeded time a little bit.
Thank you, Divyesh, for again a wonderful presentation, like always. And before giving you the formal vote of thanks, I have two things. One is that I have to ask at least one or two questions because there are a lot of questions. People are very much interested. I have seen that more than 250 people were there out of 500 plus, you had
Yeah.
registered. So there is a 50% ITC reversal, we may say. And the two questions, the first, very important, you have made an excellent presentation. 55 pages covering almost all the sectors. So people would be interested in knowing whether this will be made available to them or not. The important question.
Yeah, we'll send it across.
Yeah, yeah. So that is only one question I will take is that now the rate on the aerated drinks has been shifted from 28% to 40%. Now in the restaurant, the rate is 5% without ITC. So now when a restaurant is serving this cool drinks, what would be the actual rate? Should they be charging 5% with ITC, or they would be permitted to segregate because their ITC will be reversed otherwise? What would
Yeah.
be the
So, yeah, even when it was 28, the same question arose. And if we see the way, if we experience and sort of recall when we had ordered our aerated beverage, the waiter would open the bottle and provide it to us and not really give us the bottle with the cap or the can without being opened. So it is a service of providing us food and not really selling us aerated beverages. So they will pay 40% on procurement. They will continue to charge us 5%, but
5%?
they will obviously lose that credit of now from 28, they will go to 40%. So if they were charging us for a 30 rupee can, they were charging us $100, maybe they'll start charging us $120.
Yeah. So that is an impact. Okay. So before thanking you, there are a few announcements in the interest of the since we are having this lecture meeting, there are a lot of people available. There is one very interesting program on daughters' right in succession laws, which is a physical program which will be held in BCAS. It will be held on Thursday, 25th of September 2025 by Advocate Mrinalini Deshmukh. A very nominal charge. It is also available on a hybrid mode. So participants who wants to know this succession law relating to the daughter's right may take benefit of this either physically or through hybrid mode. The details are available on the website. We have got an IPO Conclave 2025 starting on 9th of October. There are a lot of topics, a very extensive coverage is there. It will be held at Ginger Hotel at airport, Bombay Airport. So that is also a good program to go through. We have got two residential study courses. One is the direct tax RRC. This is the first direct tax RRC that we are having on 18 to 21st of December 2025. A very extensive schedule. It will be held at Agra, Taj Vivanta. The details are again available on the website. And then we have got our 59th members residential refresher. The event will be held on 23rd January to 26th January. We have time for it, but the reason for announcing it now is that our early bird discount, the deep bird discount, will be ending on 25th. So therefore, those who wants to come, it's a very good program. Those who wants to come, and there are very limited seats. It is available to the members. So those who are chartered accountants are requested to become the member to have this particular course. With this, let me come back to the very important task which is given to me, a very pleasant task. We have been, hearing Divyesh for over 75 minutes now, and we have seen how thoroughly he has represented not just mentioning the amendments which are proposed, but also the background, why this amendment has been proposed, and little bit of the behind the curtains, stories that he has, gathered from his own experience, interactions with the officers. So thank you for such overall 360-degree analysis. Um, Very importantly, on the structural reform, you have spent a very good amount of time where you have touched some of the subjects like point of taxation, especially in the context of sale on approval basis. The credit notes, the issues when the old credit notes will be given, 12% it may not be there. The system challenges, the job work, original supply date of removal deeming fiction. What would be the case? Uh, a very interestingly, although there was a very short amount of time, still you have covered so many sectors: pharma, auto, insurance, job work, textile. Overall, I must say this was a complete treat. I believe more time should have been given to you. Maybe we will have some specific courses, sector specific courses later on. But thank you a lot for being here and enlightening us on this very important subject. I think this is a great start as far as the GST 2.0 is concerned. Thank you very much, and wish you a very good evening. Thank you, everyone. Thank you very much.
Thank you, Divyesh ji.
Thank you, sir. Thank you.
Superb, superb. Yeah, we can log out. Thank you. Thank you.
Thank you.